A bank loan is money borrowed from a financial institution that must be repaid over time with interest. When an individual or business takes a loan, the bank provides a specific amount of money under agreed conditions, including the interest rate, repayment period, and any required collateral. Banks such as JP Morgan Chase, HSBC, and State Bank of India provide various types of loans to meet different financial needs. These loans may be used for purchasing a home, expanding a business, buying a vehicle, financing education, or covering emergency expenses. Bank loans play an important role in both personal finance and the broader economy. They allow borrowers to access funds immediately instead of waiting to accumulate savings over a long period. This immediate access to capital increases purchasing power and enables individuals to improve their living standards. For example, a home loan makes it possible for someone to own property earlier in life, while a business loan can help an entrepreneur purchase equipment, hire staff, or expand operations. The effects of bank loans can be both positive and negative. On the positive side, loans stimulate economic growth. When banks lend money, consumers spend more and businesses invest more. This increased activity can lead to higher production levels, more employment opportunities, and overall economic development. Loans also encourage financial discipline because borrowers must plan their budgets carefully to meet repayment obligations. Successfully repaying a loan can improve a person's credit history, making it easier to obtain credit in the future under better terms. However, bank loans also have potential negative effects. The most obvious drawback is the cost of interest. Borrowers must repay not only the original amount borrowed but also an additional percentage charged by the bank. Over time, especially with long-term loans such as mortgages, the total interest paid can be substantial. This increases the overall cost of purchases made through borrowing. Another significant effect of bank loans is the risk of debt burden. If a borrower loses income or faces unexpected expenses, meeting monthly repayments can become difficult. Missed payments may result in penalties, additional interest charges, and a damaged credit score. In severe cases, especially with secured loans, the bank may seize collateral such as a house or car. This can have serious financial and emotional consequences. From a psychological perspective, loans can create mixed feelings. Some individuals feel motivated and focused when they have a clear financial obligation to meet. Others may experience stress and anxiety, particularly if their financial situation is unstable. Long-term debt commitments can also reduce financial flexibility, limiting a person's ability to take risks or make major life changes. Despite these risks, bank loans offer several advantages. One major benefit is structured repayment. Banks provide a clear schedule that specifies how much must be paid and when payments are due. This structure helps borrowers plan their finances effectively. Compared to informal lenders or high-interest credit options, traditional bank loans often offer more reasonable interest rates, particularly when the loan is secured by collateral. For businesses, bank loans can be especially valuable. They provide access to capital without requiring the owner to give up control or ownership, as would happen with equity financing. A company can use borrowed funds to invest in growth while retaining full decision-making authority. In many cases, interest payments on business loans may also be tax-deductible, which reduces the effective cost of borrowing. At the same time, businesses must manage loans carefully because repayments are required regardless of whether the company is making a profit. If revenue declines, fixed repayment obligations can create financial pressure and even risk insolvency. There are also disadvantages related to eligibility requirements. Banks typically require proof of income, credit history, financial statements, and sometimes collateral before approving a loan. This process can be time-consuming and may exclude individuals or small businesses that lack sufficient documentation or credit history. In addition, long-term loans represent extended commitments. A mortgage, for example, may last 20 or 30 years, influencing financial decisions for decades. Responsible borrowing is essential to ensure that the benefits of a loan outweigh the risks. Borrowers should carefully assess their repayment capacity before taking on debt. Comparing interest rates and loan terms from different banks can help secure more favorable conditions. It is also wise to maintain an emergency fund to cover unexpected expenses and prevent missed payments. Reading and understanding all terms of the loan agreement before signing is crucial to avoid surprises later. Bank loans are powerful financial tools that can support personal goals, business expansion, and economic development. They provide immediate access to funds, structured repayment plans, and opportunities for growth. At the same time, they involve interest costs, long-term commitments, and the risk of financial strain if not managed carefully. Whether a bank loan becomes a positive stepping stone or a financial burden depends largely on responsible planning, disciplined repayment, and informed decision-making. Beyond the immediate advantages and disadvantages, bank loans have long-term financial and social impacts that shape both individuals and economies. Understanding these deeper effects is essential for making responsible borrowing decisions. One important long-term impact of bank loans is their influence on financial stability. When managed properly, loans can help individuals build assets that appreciate over time. A mortgage, for example, allows a borrower to gradually build home equity rather than spend money on rent. Over the years, property values may increase, creating wealth. Similarly, a business loan used wisely can generate profits that exceed the cost of borrowing, strengthening the company's financial position. However, the long-term burden of debt should not be underestimated. Interest accumulates over time, and extended repayment periods increase total costs. A loan that seems affordable in the short term may become stressful if economic conditions change. Inflation, rising living expenses, or unexpected job loss can all affect a borrower's ability to repay. This makes long-term planning essential before taking on significant debt. Bank loans also influence credit reputation. A borrower who consistently makes payments on time develops a strong credit profile. This can lead to better borrowing terms in the future, such as lower interest rates or higher credit limits. In contrast, defaults and late payments can damage creditworthiness for many years. A poor credit record can limit financial opportunities, including renting property, securing employment in certain industries, or obtaining future loans. From a business perspective, loans can shape competitive advantage. Companies that secure funding at the right time may expand operations, invest in technology, or enter new markets before competitors. Access to capital can determine whether a business grows rapidly or remains small. On the other hand, excessive borrowing can weaken a company's balance sheet. High debt levels increase financial risk, especially during economic downturns when revenue may decline but repayment obligations remain fixed. At the macroeconomic level, bank lending drives national development. Financial institutions channel savings into productive investments. In countries with strong banking systems, businesses and individuals have greater access to capital, which supports innovation, infrastructure development, and employment. For example, major international banks such as HSBC and JP Morgan Chase operate globally, financing trade, housing, and business ventures that contribute to economic growth. However, excessive lending can create economic instability. When banks lend too freely without proper risk assessment, borrowers may accumulate unsustainable debt. If many borrowers default at the same time, banks can face financial crises, which may spread throughout the economy. Financial crises in the past have shown how interconnected lending systems can amplify risk when debt levels become too high. Another important consideration is the difference between productive and unproductive borrowing. Productive loans are used to generate income or acquire appreciating assets, such as education, business expansion, or property investment. These loans often create long-term value. Unproductive loans, on the other hand, may finance short-term consumption without generating future returns. Borrowing for luxury items or non-essential spending can lead to financial strain without improving long-term financial position. Risk management plays a central role in responsible borrowing. Borrowers should evaluate their debt-to-income ratio, ensuring that monthly repayments do not consume too large a portion of earnings. Financial experts often recommend keeping total debt payments within a manageable percentage of income to reduce stress and maintain flexibility. Maintaining savings alongside loan repayment provides a safety buffer in case of emergencies. Interest rate structure also matters significantly. Fixed-rate loans provide stability because the interest rate remains constant throughout the loan term. This allows borrowers to predict their payments accurately. Variable-rate loans may start with lower interest rates but can increase over time depending on market conditions. While variable rates may offer initial savings, they carry the risk of higher future payments. In addition, borrowers should consider opportunity cost. Money used to repay debt cannot be invested elsewhere. In some situations, it may be financially beneficial to repay high-interest loans quickly. In others, particularly when interest rates are low, investing excess funds may generate higher returns than the cost of borrowing. Careful financial analysis helps determine the best strategy. Bank loans are complex financial instruments with far-reaching effects. They can create opportunities, build wealth, and stimulate economic growth when used wisely. At the same time, they can lead to long-term financial pressure, reduced flexibility, and economic instability if mismanaged. The true impact of a bank loan depends not only on the terms offered by the bank but also on the borrower's financial discipline, planning ability, and understanding of risk. Responsible decision-making, careful budgeting, and long-term thinking are essential to ensure that borrowing becomes a tool for progress rather than a source of hardship. In addition to financial and economic impacts, bank loans also have social and ethical dimensions that influence individuals and communities. Access to credit can significantly shape social mobility. When people are able to borrow responsibly for education, housing, or entrepreneurship, they often gain opportunities that improve their long-term quality of life. Educational loans, for instance, can allow students to obtain qualifications that increase their earning potential. Over time, this can reduce income inequality and strengthen the middle class. At the same time, unequal access to bank loans can widen social gaps. Individuals with strong credit histories and stable incomes typically receive better loan terms, including lower interest rates. Those with lower incomes or weaker credit profiles may face higher rates or loan rejection. This can create a cycle in which financially disadvantaged individuals struggle to access affordable credit, limiting their opportunities for advancement. Financial literacy therefore becomes an essential factor in ensuring that people understand how borrowing works and how to improve their eligibility. Ethical considerations also arise in bank lending practices. Banks have a responsibility to assess a borrower's ability to repay before approving a loan. Responsible lending protects both the bank and the customer. When financial institutions fail to evaluate risk carefully, borrowers may take on obligations they cannot manage. This not only harms individuals but can also destabilize entire financial systems. The balance between profitability and social responsibility remains an ongoing debate in the banking industry. Technological advancements have changed how bank loans are processed and distributed. Many large banks, including JP Morgan Chase and HSBC, now use digital platforms that allow customers to apply for loans online, receive quick approvals, and manage repayments through mobile applications. Automation and data analysis have improved efficiency and reduced processing time. However, digital systems also raise concerns about data privacy and algorithmic bias in credit scoring. Another important practical consideration is the total cost of borrowing beyond interest rates. Loan agreements may include additional fees such as processing charges, late payment penalties, insurance requirements, and prepayment penalties. Borrowers who focus only on the interest rate may underestimate the true financial commitment. Reading and understanding all terms and conditions before signing a contract is crucial to avoid unexpected costs. Bank loans also influence personal financial behavior. Regular repayment schedules encourage discipline and structured budgeting. Borrowers often become more aware of their income, expenses, and savings patterns. This increased awareness can improve long-term financial management skills. On the other hand, excessive reliance on borrowing can encourage overspending and reduce the habit of saving. Striking a balance between responsible borrowing and healthy saving habits is essential for sustainable financial health. In times of economic crisis, governments and central banks often intervene to support lending systems. They may reduce interest rates to encourage borrowing and investment, or provide financial support to banks to maintain stability. This demonstrates how closely linked bank loans are to national economic policy. Lending activity influences inflation, employment, and overall economic growth. Cultural attitudes toward debt also vary across societies. In some cultures, borrowing is viewed as a normal and practical financial tool. In others, debt may carry social stigma. These attitudes can influence how individuals approach loans and manage financial obligations. Understanding cultural perspectives can help explain differences in borrowing behavior across regions. Looking toward the future, sustainable and green financing is becoming more prominent. Banks are increasingly offering loans that support environmentally friendly projects, such as renewable energy installations or energy-efficient housing. This reflects a growing recognition that lending practices can contribute not only to economic growth but also to environmental sustainability. Bank loans extend far beyond simple financial transactions. They affect social mobility, economic stability, ethical standards, technological innovation, and even cultural attitudes toward money. When approached thoughtfully, bank loans can empower individuals and businesses to achieve meaningful goals. When misused or poorly managed, they can create long-term hardship and systemic risk. A comprehensive understanding of financial responsibility, careful planning, and awareness of broader impacts ensures that borrowing remains a constructive force in both personal and societal development. As financial systems continue to evolve, the discussion of bank loans must also include risk management strategies and available alternatives. Borrowing is not the only way to finance personal or business needs, and understanding options allows individuals to make balanced decisions. One of the most important aspects of managing a bank loan is assessing risk before borrowing. Risk begins with income stability. A borrower who depends on irregular income faces greater difficulty maintaining consistent repayments. Therefore, long-term loans require realistic forecasting of future earnings. Changes in employment, health conditions, family responsibilities, or market demand can all influence repayment capacity. Careful planning reduces the likelihood of default. Interest rate risk is another key consideration. In economies where interest rates fluctuate frequently, borrowers with variable rate loans may experience sudden increases in monthly payments. This can strain household budgets or business cash flow. Fixed rate loans offer predictability, which is often safer for long-term commitments. However, they may start at slightly higher rates. Choosing between fixed and variable structures requires evaluating market conditions and personal risk tolerance. Liquidity risk also plays a role. Liquidity refers to the ability to access cash quickly. A person who invests all income into loan repayment without maintaining savings may struggle during emergencies. Financial experts often recommend building an emergency fund covering several months of expenses before committing to large loans. This financial cushion provides security against unexpected disruptions. Beyond traditional bank loans, alternative financing options exist. Some individuals rely on savings, family support, or cooperative lending systems. Businesses may explore equity financing, where investors provide capital in exchange for ownership shares. Unlike loans, equity does not require regular repayments, but it reduces the original owner's control. Each financing method carries its own advantages and disadvantages. In recent years, digital banking and financial technology have expanded lending accessibility. Major institutions such as State Bank of India have adopted online loan processing systems to speed up approvals and reduce paperwork. While technology improves efficiency, borrowers must remain cautious about cybersecurity risks and ensure they are dealing with legitimate financial institutions. Another important factor is long-term financial planning. Loans should align with broader life goals. For example, taking a mortgage may be reasonable if it supports stable housing and asset growth. However, borrowing repeatedly for non-essential consumption may conflict with long-term wealth-building objectives. Financial decisions should be consistent with personal priorities such as retirement planning, children's education, or business sustainability. Economic cycles also affect loan outcomes. During periods of economic growth, borrowers may find it easier to repay due to higher income and job security. During recessions, reduced demand and unemployment can increase default risk. This cyclical nature of economies means that borrowing decisions should consider not only current conditions but also potential downturns. Another dimension is inflation. Moderate inflation can benefit borrowers because the real value of fixed repayments decreases over time. However, high inflation often leads to higher interest rates, increasing borrowing costs. Understanding the relationship between inflation and interest rates helps borrowers anticipate future financial pressures. Ultimately, the decision to take a bank loan should be based on careful evaluation rather than immediate need alone. Borrowers must weigh the benefits of immediate access to funds against the long-term cost of repayment. Responsible borrowing requires honesty about financial capacity and discipline in meeting obligations. In final evaluation, bank loans are neither inherently good nor bad. They are financial tools. When used for productive purposes such as education, housing, or business investment, they can create long-term value and economic progress. When used carelessly or without adequate planning, they can result in financial stress, loss of assets, and reduced opportunities. The key lies in knowledge, preparation, and moderation. Understanding interest rates, repayment terms, total cost, and potential risks empowers borrowers to make informed decisions. Maintaining savings, diversifying income sources, and aligning borrowing with long-term goals ensure that loans support financial growth rather than hinder it. Bank loans remain central to modern financial systems and personal development. Their true impact depends on how wisely they are managed. Through strategic planning, responsible use, and awareness of economic conditions, borrowers can transform loans into instruments of opportunity, stability, and sustainable progress. As the global financial landscape continues to evolve, bank loans are also changing in structure, accessibility, and regulation. Modern banking is increasingly influenced by digital transformation, globalization, and shifting economic policies. These changes affect how loans are offered, approved, monitored, and repaid. Understanding future trends helps borrowers prepare for a more dynamic lending environment. One significant trend is the expansion of digital lending platforms. Large international banks such as JP Morgan Chase and HSBC have integrated artificial intelligence and data analytics into their credit assessment systems. These technologies allow faster decision-making and more personalized loan offers. Customers can now apply online, upload documents digitally, and receive approval within hours or days instead of weeks. This convenience improves accessibility but also increases the need for digital literacy and cybersecurity awareness. Another emerging trend is sustainable and socially responsible lending. Banks are gradually directing funds toward environmentally friendly and socially beneficial projects. Green loans, for example, support renewable energy, eco-friendly construction, and sustainable agriculture. This reflects a broader understanding that financial institutions play a role not only in economic growth but also in environmental protection and social development. Regulatory frameworks are also becoming stricter in many countries. Governments and central banks impose rules to ensure that lending practices remain responsible and transparent. These regulations aim to prevent excessive risk-taking and protect consumers from unfair terms. Strong regulation promotes financial stability but may also make loan approval processes more detailed and selective. Personal responsibility remains the most critical factor in successful borrowing. Regardless of technological advancements or regulatory changes, the borrower ultimately decides how much to borrow and how to manage repayment. Financial literacy is therefore essential. Individuals should understand concepts such as compound interest, amortization schedules, credit scores, and debt-to-income ratios before committing to a loan. Long-term financial well-being requires balancing borrowing with saving and investing. While loans can accelerate asset acquisition, savings provide security and independence. A healthy financial strategy includes building emergency funds, planning for retirement, and setting clear financial goals. Loans should complement these goals rather than replace sound financial planning. Another important consideration is ethical decision-making at the individual level. Borrowers should avoid taking loans for unnecessary consumption that does not contribute to long-term stability. Responsible borrowing involves honesty about income, careful budgeting, and commitment to meeting repayment deadlines. Defaulting intentionally or neglecting repayment obligations can harm not only the borrower but also the broader financial system. As societies become more interconnected, global economic events can influence local borrowing conditions. Interest rates, inflation trends, and international trade policies affect lending costs and availability. Borrowers who stay informed about economic developments are better positioned to adapt to changing conditions. Bank loans are powerful financial instruments that shape personal lives, business success, and national economies. They provide immediate access to capital, support economic growth, enable asset ownership, and create opportunities for advancement. When used productively, loans can improve living standards and generate long-term wealth. At the same time, loans carry significant responsibilities and risks. Interest costs increase total repayment amounts, long-term commitments reduce financial flexibility, and mismanagement can lead to serious financial and emotional consequences. Economic fluctuations, income instability, and poor planning can transform borrowing into a burden. The overall impact of a bank loan depends on informed decision-making, disciplined financial management, and awareness of long-term consequences. Responsible borrowing requires evaluating necessity, understanding full costs, maintaining financial reserves, and aligning debt with meaningful goals. In essence, a bank loan is not simply borrowed money, it is a commitment that shapes future financial possibilities. When approached with knowledge, caution, and strategic planning, it can be a tool for growth and stability. When handled carelessly, it can create lasting hardship. The difference lies in preparation, responsibility, and wise financial judgment. Thank you for watching this video.